Hi, everyone. Welcome to another episode of Talking Deals with David. Today, we really have what I think is going to be a very interesting discussion. And I think from some of the comments and DMs that I got over the weekend and today, I think there are a lot of people that are following my posting that either do M&A deals or restructurings, recapitalizations, and are wondering a bit about fairness opinions and solvency opinions. And so I think our goal today is to give you a high level overview of what fairness opinions and solvency opinions are, and then dig a little bit deeper into the process that goes into putting together a very rigorous, careful, informed analysis. And we'll talk a little bit, I think, about some of the legal underpinnings behind fairness opinions and solvency opinions, and give you a little flavor, perhaps, of some of the history of how it developed, the practice developed the way it did, and where we are sitting now in 2023. And I'm joined, William and Chow. Thank you so much for joining me today. I appreciate it.
Sure. Thanks, David. Yeah, we're looking forward to this. This will be fun.
Thanks. Yeah, I think it will be. I know some people, probably saw fairness opinions, solvency opinions. This doesn't sound that fun, but I think it really is, and I also think that it's such an important part of doing, complicated transactional work, that you really, whether you're in-house or whether you're an advisor, or of course whether you're a director on either a public or private board, you really have to have a good sense about what makes a good fairness opinion or solvency opinion, and what makes a not so good one that isn't going to stand up in a litigation context. And for those watching, as I think a lot of people have watched these before, please comment. You can actually, put some comments in now that let us know where you're listening in from. And if you do have comments, I'll try to monitor those, as we're going. So if I'm looking kind of off the screen, you'll probably imagine that I'm checking out some comments. We'll try to address those. And as people start coming in, William, do you want to just maybe give a quick introduction, and Chow, just let everyone know who you are, your background a bit?
Sure. First, thanks for everybody for joining us. Chow and I are part of Berkeley Research Group's corporate finance group. Specifically, we're in the transaction and valuation opinion side of the business. Chow and I have been working together for over a dozen years now. Chow, is that right? We started when we were 20 years old.
Very much.
Yeah, and while we wear a lot of different hats in terms of valuation, Chow and I have just migrated toward transaction opinions, it seems like, over the last, 12, 15 years. I've been doing it longer. But we regularly are working on solvency and fairness opinions, and we'd love to talk a little bit more about what they are, and look forward to this. So why don't I jump in a little bit? When David invited us to participate, just giving some thought, sort of high level, what are fairness opinions, what are solvency opinions? Fairness opinions, when you think about it simplistically, it's fair from a financial point of view. So there's analysis, which we can talk about that later, but there's analysis that goes into valuing the company, the asset, or whatever's being transacted, and an analysis is done to compare that or the terms of the transaction to our analysis. One of the things that goes into a fairness opinion as well, or what we look at, is what process was run by the board or the management team. And again, we'll talk about that, I think, a little bit more later. Process is important for us. We ask those questions up front on fairness opinions. What process was run? If it was a sell side, was it broadly shopped? All those types of questions. On the solvency opinion side, We follow the standard solvency test. So if you were to look at our, bankruptcy statute, it talks about what makes a company insolvent. So the solvency opinion does an analysis around what is solvent. So there's 3 tests. Some of it has to do with value. Some of it has to do with just simply being able to meet its obligations as they go forward. And then the third test, typical third test is just an adequate capital test. So all 3 are important. 2 of the 3 are value-based, but there's a lot of capital markets analysis that goes into it. There's a lot of analysis and diligence around downside scenarios and things like that. So if we look at examples, if we want to look at examples, when are fairness opinions actually obtained? And there's the classic sort of buy side or sell side fairness opinions. All you have to do is look at proxy materials on a public deal. Those are sort of the classic examples. But we also see a lot of private deals that require fairness opinions, largely around conflicts. For example, private equity groups who have portfolio companies that are transacting with each other or merging with each other, but they're part of different funds, will often get fairness opinions just to make sure that the LPs in each fund feel like they're being treated properly. So no one's getting a more fair deal, if you will. Another example comes up, as we enter into more and more of a distressed side of the economy, we're going to see more out of court kind of transactions where you've got like debt for equity swaps, you've got rescue financing coming in. Maybe the rescue financing is not coming from a third party. It might be an existing stakeholder somehow. So there's a sensitivity there as well. Other situations include things like VCs who are doing down round financings. That's also an area where we'll often see fairness opinions be requested. A lot of those sort of special situations where there's sensitivity around stakeholders and stakeholders being diluted or completely crammed out. On the solvency opinion side, it's the classic LBOs, it's dividend recaps, there's spinoffs, there's other types of transactions that require solvency opinions and the advice of a financial advisor there.
Yeah, let me actually unpack a little bit of that and ask you some questions maybe to clarify it. First of all, when we set this up, we kind of combined them. We talked fairness opinions and solvency opinions. I know and can imagine there are some deals where you do both, maybe a leverage type transaction, but often you might only see one or the other. So they're 2 separate opinions most often. On the fairness opinion side, William, as you said, they can be used in lots of different circumstances. Sometimes people, think they're limited to, your public company deal where you need seller shareholder approval. And of course, that's, I guess I would say, the kind of prototypical one. And you can, find examples of those fairness opinions and the descriptions in the proxy statements, William, as you mentioned. But they're also used in all kinds of other, significant corporate transactions, public and private. But I do think that, since the kind of mid 80s, it's become, very common. And that was the result of a Delaware opinion that kind of tagged a group of independent, sophisticated directors with personal liability because they didn't have a good independent basis for sort of assessing the value. In that case, it happened to be a leveraged buyout, which were, very typical back in that mid 80s time period. But nothing that I'm aware of, other than I think there might be a California statute in tender offers that has some, requirement to do a fairness opinion. But as far as I'm aware, there's really no SEC or Delaware law or state law that says you must get a fairness opinion. but it's become very typical practice in larger deals or deals where you have conflicts that you'll get a fairness opinion. And the reason, I think, is to give a independent view of the financial, consideration that's being provided in a deal. And also, I guess, on the back end, if you're looking at it a little bit more, from a protective standpoint, it gives the directors the comfort that they know that they've had someone, not internal, not inside, not, conflicted in the deal, take a look and vet and double check the numbers and give a feeling as to whether or not the consideration is fair. But that's one thing I wanted to ask you. What does it mean? The fairness opinion, I was always intrigued by them when I first started, and I imagine some people are as well. They're very short. If you haven't seen one, they might be 3 pages, 4 pages. You don't really get the feel for what's behind them until you see kind of the board decks or the supporting information, which, can run many hundreds of pages, with, numbers and calculations and supporting information. But the fairness opinion itself is pretty compact, and it just says that the consideration in the deal is fair as of a particular point in time, from a financial point of view. What does that mean? What do you take that to mean, and what shouldn't we take it to mean, I guess, on the flip side?
Sure. So when we think about it, it's easier for me to talk about what it doesn't say, right? So financial point of view simply to me means that we're looking at the economics of the deal and whether it's fair to whatever stakeholder group that people are concerned about. It's not a tax opinion. It's not a legal opinion. It's not even a recommendation, right? For if it's something's up for a shareholder vote, we're not recommending that the shareholders vote for it, or even that the board approve the transaction. We're simply saying, look, based on the economics of this transaction, we think that the consideration to be paid or received, or however the transaction is structured, is fair to the company, or it's fair to the shareholders, depending on sort of where the economics are flowing. And that analysis is really a valuation analysis, around the target or the subject company in general, on ranges of value. There are a lot of perhaps assumptions that go into the value that have to be highlighted. I mean, you bring up something I think is really important, David, which is the opinion itself is only 3 or 4 pages. It says, here's the transaction, here are the things we reviewed, and by the way, it was approved by a fairness committee, and we are issuing this opinion that it's fair. That's all it says. It will also contain material assumptions in our analysis, but really for the board to really understand what we did and how we did it, it's really important to have that board presentation done.
Yeah, I'll add to what Williams is saying about the opinion letter. Oftentimes, it's really a legally worded document, right? To the point what Williams is saying, it will actually say in the opinion letter, we are not making recommendations. This is our independent analysis. So there is that whole process in place where we will have our counsel negotiate with client board counsel to make sure that legally we all agree with what are the disclosures, what are the key assumptions. But that's one of the points. That's why the board presentation is important, because again, it's a 3-4 page document that is very much legally written.
Yeah, that's really important point, Xiao. I mean, sometimes even, we do our analysis and there's some things that management asks us to assume. There's I don't know, it could be environmental liabilities or something, and the opinion may not flush that out exactly. So going back to that whole board presentation, David, that's where things sort of get in a spotlight. The board members can actually see, oh wow, they made that assumption, and maybe they agree with it, and maybe they say, well, why did management ask you to assume that doesn't seem right. So that I think that's a great point, Joe.
Yeah, it is. Well, let me drill a little bit down deeper into that because let's take a public company transaction and let's say it's a typical sell side engagement that you're doing, and I think in a sell side situation, it's virtually 100%. Let's say it's close of getting fairness opinions in deals like that. So if you are the target and you're a public company and you're doing essentially a sale transaction where somebody is buying you and essentially cashing out, let's say, your public company stockholders, you'll almost always, and that's a result of that Delaware Smith versus Van Gorkum case I mentioned, you almost always have a fairness opinion, maybe two, but at least one in that deal. And as William and Chow said, it will have a set of assumptions, which is one of the first things I look at. I don't know what other people look at, but for me, I always look through those to see if there's any assumptions that look off, looked out of whack. Certainly don't want to assume things that obviously are not true, because then you call into question the entire kind of foundation that the fairness opinion sits on. But it opines, William, as you said, on the financial fairness. It doesn't say that it's the highest price that you could have obtained, which is more typical in Delaware of sort of the Revlon type board requirements. It doesn't go into, whether this is the best deal for the company or the stockholders or any of the other social or other important factors that go into, making a decision, but it drills down on that. One thing that I think struck a lot of people, back in the 80s when you had that Smith versus Van Gorkum is that deal, which was criticized and where the public company directors were tagged with personal liability, was at like a 40%, 48% or 50% premium to where the stock was trading. And again, we're talking public companies for this example. So you have a trading price. William, why isn't it just sufficient to look at the deal price and sort of ask yourself, is it a substantial premium off of where the market is trading? Doesn't that in and of itself, show that the transaction is fair, like in that Smith versus Van Gorkum case? Why do you need to dig deeper, and what in fact are you looking for beyond just where, the market price is trading in a public deal?
Right. I mean, sometimes the market price isn't always indicative as well of value. And we think about a change of control transaction. There might be some, whether it's market specific or company specific things going on that maybe artificially reduce the stock price or lower the stock price so that, a 40% premium sounds nice. And we can all believe sort of market efficiencies, the market speaks, maybe it's a company that's the stock doesn't trade that regularly or who knows what the case is. So to have that extra independent set of eyes look at it is important. And it also, as I mentioned, one thing that we look at and consider is the process, right? So if it's a sell side and you talk about a 40% premium, did they go out and hire a banker to run a process and they contacted the logical strategic buyers and potential financial buyers, and did they do all that or did they not, right? So we have to really be careful. But to your point, it doesn't always have to be the highest price. We've been in situations where there's a deal on the table. It's fair. We've done analysis, and then a superior bid comes in. Does that mean the prior bid was unfair? I think that happens on occasion, and it doesn't. To your point, it doesn't mean it's always the highest bid.
Yeah, and I'll just add on one thing. When we're doing our valuation analysis, we have material non-public information. We have projections. We have diligence with management to try to understand where this company is going. That might not be disposed to the capital markets. And if you look at the meme trading that was happening in 2020, if you were just to benchmark it off of a skyrocketing share price of one company, is it then not fair because the market just reacts irrationally? So I think there's a balance, and there's something we have to bridge as well as when we're looking at public companies is what is the actual trading price and how does that bridge to our intrinsic valuation at the end of the day?
Yeah, I think that's terrific, and it's helpful to get that for people that were kind of, I guess, trained in, traditional finance, and you had sort of the efficient markets hypothesis and things that you can see complaints where people say, well, boy, I should just look at, whatever the premium is. And if it's sufficiently high, now, whatever that means. But in the Smith versus Van Gorkum case, that's what was done. I mean, you had it's almost a master class in what not to do. And it still stands, I think, as a pretty good read for people that want to, delve a little bit deeper. And there's other things in that case, that are interesting too. But, you had a very powerful CEO that was, pretty demanding and insistent on his particular view of what the company was worth and where it was going. And that 50% premium, 48 or 58% premium, in his mind, which he set and viewed as supportable in the LBO, made a lot of sense. But what he did do was consult with the CFO, his own, CFO, who the record showed was, very sort of dependent upon the CEO and wanted to, curry favor with him. There wasn't any process to bring in any third party. And it was also a very abbreviated board process. So the board members weren't given any ability to, dig deeper into what the intrinsic value of the business was, or, Chow, as you mentioned, any, forward-looking projections that might cast a little bit of a different, pale on what the company might be worth. And so all they were confronted with was the CEO's recommendation, plus this pretty, what looked on paper to be a pretty significant premium. And so, they approved the transaction, over a weekend or a very short period of time. And all of those things were critical. So, Chow, maybe we'll come back to solvency and some other things in a little more detail. But since we're talking about process, Chow, what are your thoughts about that in terms of what you like to see in a process as part of how you're engaged, how a firm like BRG would be engaged, and what you're looking for as you're thinking about undertaking an engagement, either for a solvency opinion or a fairness opinion?
Sure. Maybe I'll take a step back and just go over the actual timeline of from a start of an engagement for opinion to the issuance of the opinion. So where we like to come in is usually when the deal has some kind of a firm terms being negotiated. It doesn't really make sense for an advisor to get engaged at the very beginning because the deal terms can continually change. So we'll be continually updating our analysis. And that's not a good fact pattern either. You want to, when the deal is ready to be more formalized, there's terms agreed upon, maybe you're just looking at smaller tweaks here and there, disclosures, warranty reps, then that's when I think it's a good time for us to get engaged. So what you're looking for is independent third party. The firm that is doing is reputable. They've done fairness opinions in the past, maybe in similar industries. Unless it's very esoteric, then no one really does it until you do it. But the process is very much the same. Once we're engaged, there will be negotiations with engagement letter. Again, I go back to this is a bit of a legal process, but part of that is the client also wants to make sure that the opinion expresses from what is the financial point of view. A lot of time is taken to actually map out what is the consideration here that's being opined on. Otherwise, it's just garbage in, garbage out at that point. And once we start, we work very closely with management team. We, gather information, we vet the projection, vet the financials, have numerous calls for diligence. And then as that process is taking place, we're also negotiating the actual opinion letter that I mentioned earlier, because you don't want to wait until the very last minute to do it. You want to make sure all the language, and as we go through and management start thinking a little bit more about what that opinion actually says, then is a good dialogue. And also is a good way for us to firm up all the terms that are being considered as it does change sometime up to the very last minute. And once we have finished our analysis, which is usually 3 to 4 weeks, that's a good typical timeline for us. Then we will present to an internal review committees of senior management. Their job is to poke holes in the analysis, make sure that we haven't forgotten anything, no contingent or certain aspect that the team hasn't looked at. And then, once they approve the issuance of the opinion, then we can go ahead and actually issue the opinion. What we would like to see is a board presentation being taken place. I would say 50% of the time it does and it does not, because you'll always get your opinion letter, which is a couple pages. But where I think we're value added to the process is when boards of directors can review our board presentation, have us go through the key analysis, key assumptions, and give them the opportunity to really ask the question, like, how did you come up with this contingent? Are there other things you're missing? How do you get comfortable with the discount rate, for example, if it's in a highly volatile industry? And once the board has a chance to review, they'll usually vote for approval. And then once that's done, we also issue our opinion as well, usually in tandem. But what we would like to see is that opinion being issued close to the closing date. Sometimes we have clients that ask for it like a month in advance, or it gets delayed. And that becomes a problem, because if you're looking at the capital markets, things change. So you want to be as close as possible. And if there are subsequent transactions to it, then there may be a bring down. So that's high level of the process. William, do you want to add anything else?
Yeah, I was just going to say one thing on the initial agreement is my antenna goes up a little bit. You think it'd be only, sort of small companies, maybe private companies that do this, but surprisingly, there's very large companies that do the same thing, which is they actually don't have outside counsel certainly review our agreement. I'm not thinking indemnification, those kinds of things. I'm really thinking more, what are we opining to? Sometimes, we think we know what the opinion should be or what we're opining to, but there might be some other feature of the transaction that's important to the client, and having outside counsel provide input is critical, because we don't want to get to the end of the process and have counsel suddenly step in and say, well, that's not really the opinion we need. We need something else. And that somehow maybe that changes the analytics, and we have to sort of backtrack and do some additional work here. And that could cause delays. So I think that's a key part here too.
Yeah, that makes sense. So scoping out, and again, the only way counsel, I think, is able to get that is to have not only a good understanding, of the deal itself and what are the components of the deal, but also have sort of, again, that eye on potential litigation, potential complaints. Could be stockholders, it could be an activist, it could be, creditors in the context of perhaps a solvency opinion. But you really have to kind of start looking kind of around corners and anticipating where could this transaction be challenged? Where are the weak spots that we're seeing? And then in consultation, William and Chow with you, figuring out what the right scope is, and also making sure that you're not, again, making assumptions or doing other things within the scope of the opinion to kind of narrow it, or in a challenge situation where it starts to look, a bit weaker. So having those discussions kind of early on, makes a lot of sense to me. I guess the one thing, William, you were talking a little bit about kind of the analytics going into behind the opinion. One thing I've was surprised by, and maybe I shouldn't have been, but I'm not, an expert as you are, but little changes in the discount rate, Chow, you mentioned, or the projections can make a huge difference in the value range that you get. So maybe you could touch on a little bit the different approaches that you'll use, and let's say in a fairness opinion context where you're trying to get that sense of, is the consideration being paid fair from a financial point of view? You won't just look at sort of the typical, discounted cash flow analysis, but that sort of seems to be the predominant one. But is it true? What my reflection is that small little changes can make significant differences. And so the kind of the underpinnings of how you base your opinion, make a big difference. It's important to kind of understand how those work and what kind of levers will adjust, as you're thinking about doing a fairness opinion.
Yeah, I go back to diligence. This is where diligence is the key input, right? Because otherwise, if it's garbage in, garbage out again, that's the phrase. Typically valuation, you have their DCF. You also have public, looking at what the public comp is trading at and using the implied multiples, applying it to your revenue or EBITDA. And also similar with similar transactions, what transactions have been done in the industry. Now, all of that comes back to what do you believe this company to be? What are their performance, right? There's a lot of diligence in terms of, what the revenue is going to be next 5 years for this company, what the margins look like for next 5 years. And all of it flows down to what's the ultimate earnings that we are either performing DCF, a cash flow approach on, or capitalizing it in the market approaches. And one thing I'll add on with the best practices is usually we like to be in person diligence. I know over the last couple of years we've done a lot of Zoom calls as part of the process, but I think things get lost when you have hour and a half, 2 hours with management, and it's just oftentimes it feels like you're grilling them. So it's more like rapid fire questions, which you do get a lot out of it, but I think you miss a lot of it when you go to in person, which we actually started going back, and it makes me miss not the traveling part of it, but miss the actual being in the room with management. And I'll give you an example. When we did a boiler fairness or solvency opinion years ago, 2-3 years ago, is boilers. Everyone thinks, oh, it's industrial boiler, maybe what you see in the basement, but bigger. But what we didn't fully appreciate, or I didn't fully appreciate, is until you walk through the entire plant with management and you see all of the intricacies. And they were building boilers that were 2-3 stories tall and really wide. So they were telling us, well, customers are locked in. There's so much customization. This is something they really need. It's not like they can go to someone else and do and be able to have capacity to build this, and to truck this to the site, you have to take down lampposts in small towns. So all of those anecdotal stories and being able to just press on and ask the question as they're bringing up, like, oh, this customer ordered this, and then you can ask about, okay, well, how does that customer impact your business? How much of it? So a lot of those add-on question, free flowing, it adds so much more to the diligence, as well as give us a better view on how the business actually operate with manufacturing and how that translate to your P&L and your projections, versus just going how you project 5%, for example, or 10% next year. So what does that mean? I think that context gets lost when you don't do in person. There's a cost factor and the speed of that things need to get done, but ideally I would always advise an in-person diligence, and especially with management. The other thing with diligence that I've seen over the past years is, depending on how active the sponsor is, that are you doing fairness or solvency, they may actually be the one that you're counteracting with as you're doing your diligence, and management might not even be available. Now, that's,
You mean more on like private equity deals, you're saying?
Yes.
Yeah. Okay.
Yes,
So it's private equity
deals.
sponsor. I see.
Which is fine, because oftentimes those private equity really do understand the business. They really are helping to shape the future of that investment that they put in. But what we, as a process, what we would like is to be able to have management separately, talk through the diligence with us. Because if you think about the optic, if management is representing the company and we are representing the board, we should really be working with management. So those are things that I've seen for best practices, in-person diligence, and really diligence with management themselves.
Especially, David, especially on like, you think about a dividend recap, right? Equity sponsors pushing through a dividend recap, but there's a conflict there. They want to get the money out of the business. So, let's talk to management.
Yeah, you have to be really sensitive to that. And to me, that's where, again, outside legal counsel, can be very helpful, because sometimes, again, even with internal counsel, there's a lot of careful juggling that you have to do. And sometimes, it's a bit easier if you sort of foist that on someone else. But yeah, it does strike me, Xiao, when you're talking about that, it's so important to think about those process drivers. Where could conflicts sort of come up? How do we mitigate those? And the one thing that strikes me, and I know you both are closer to that, probably follow this a bit more closely. If you read any of the Delaware, cases where fair value in an appraisal proceeding has been challenged, or a deal process has been challenged in an M&A transaction, and I use Delaware just because you tend to see a lot of them in the Delaware courts. They're very sophisticated. I've heard complaints sometimes from fairness opinion kind of professionals, but my experience with the Delaware Chancery Court is they're very knowledgeable, and they often will dig very deep, into the fairness opinion foundations, and they'll look at everything from the terminal values to why you selected a discount rate. Should you apply, company specific adjustments? Very, very deep. So you can't assume that, when you do the work that, you're not going to have this kind of searching look. So when you select someone to do a fairness opinion or a solvency opinion, not only do you need somebody that's really smart, really capable, knows what they're doing, and doesn't have conflicts, but, also I think that you have to have somebody that's going to be able to support, maybe in a litigation context, comfortable doing that, because in these challenge transactions, it's not a superficial look. A lot of times it's a very deep searching kind of review of how the opinion, was prepared, and what process was taken, and what all the inputs and variables and what decisions were making. And have you sensed that as well, or is that your sense?
Yeah, I would say, yeah. And it comes up sort of two places, right? One is each financial advisor that's doing the work, they have their own procedures, and they should follow those procedures. That's sort of check the box kind of thing. But also from an analytical standpoint, we have to support every assumption we make, whether it's a discount rate, maybe it's because we've been doing this a long time, but we can, we do a lot of work. We know what to do to tell the story about why we select a certain discount rate, or why we did or didn't use a company specific risk premium. We triangulate all of the valuation methodologies, right? They should sort of come together. Is the DCF a lot higher than the market approaches? Does that make sense? Or are the projections too optimistic? Where it gets, I think from a financial advisor perspective, a little more interesting is, the classic sort of merger of two companies, and you're doing a solvency opinion. All of a sudden, what's in the spotlight? The synergies, and that, there is, I think areas where, people could. You talk to 10 people, they have 10 different ways of talking about it. But there, as the financial advisor, it's documenting all the diligence. It's understanding, how these synergies are going to really work. Is there's the synergies they can do right away. Maybe it's layoffs, it's a close a plant, or whatever it is. And then there are all the, I'll call it, more gray area synergies around purchasing power and all those types of things, and being able to sell more products to a certain a mutual customer, and all those types of things. That is an area where we do a ton of diligence around. Hopefully, I would advise clients, if they can, if it fits in, is to actually have third-party consultants come in and really scrub the assumptions underlying these synergies, and make sure that it all makes sense. We're working on a deal now that has just that, has a ton of synergies involved. There must be 3 or 4 different sets of consultants, and they're looking at different parts of the integration and what that means. And that's important to the solvency analysis. Hopefully, the solvency doesn't rest just on the synergies. Hopefully, there's a little more cushion than that. But there's I've seen some of the Delaware chancellors in action in conferences and things like that. They're super smart. They ask really good questions. They understand it. So that's why, again, I go back to the financial advisor really documenting how they choose or make certain assumptions, again, on multiples. You got to have the grid. Here are these other public company comparables, why they trade between, I'm making this up, 8 and 10, and you selected a 12. Does that really make sense, Mr. Epstein in court, right? So you really have to document it. Why are we picking that multiple? And all that has to be in our files in support of that.
Yeah.
Well, one thing I noticed that is always, I thought was kind of amusing as this developed over time was that it was the Delaware courts themselves that sort of thrust fairness opinions to become, essentially a mandatory process of bigger deal M&A, especially public deals, right? So it was kind of that statement in this Smith versus Van Gorkum case that led lawyers, like me and others to say, you need to have these in all of your deals to kind of have this independent support for your business judgment that you're making so that you can be an informed board. What's kind of amusing to me, though, is that there's the same Delaware courts are skeptical about them. And that's the way I would say. And some of the posting I did, I kind of jokingly said, is it worth the paper it's printed on? But that's the impression that you get from some of these cases. So on the one hand, they say you should definitely get them because they provide that independent support that you need in exercising your fiduciary duty as a director and becoming informed. And then on the other side, they say, what good are these things for? They're inherently suspect because there's so many different variables, so many different things that go into it that, are they really useful? So I always found that kind of weighing a little bit strange when you're thinking about it. But one thing I wanted to mention on the process point, Chow, is one of the reasons that you have multiple opinions sometimes is, and one thing that's, kind of bugged me a lot over the years, one thing that's not independent is a sort of the investment bank whose compensation is typically structured to be kind of back end based on the success of the deal and sort of a contingent fee. It's typical that bank will give an opinion. But if you don't have a deal that's been shopped very well and you have other certain factors that go into it, I've at least suggested, and I think others, do as well, but I'm curious on your thoughts, that it's important in those cases to get a second opinion from, an independent financial advisor that doesn't have any contingent consideration or payment streams that are based on the closing of the deal. But do you both, agree with that? Is that one of the areas where you might want to get a second opinion, or do you might want to just eliminate the first opinion? I always wondered whether having two, is that doubly better, or might it be better just to have the independent opinion rather than have sort of dueling opinions with maybe contrasting, discount rates and methodologies? But what are your thoughts on that?
Yeah, I would always advise one opinion. It's just never, in case, if everyone is going to have a different view, it's an art, not an exact science and valuation. What you don't want to put forth is too conflicting opinion. But what I would say is for us, as financial advisor, we don't do contingent fee because just the appearance of having a contingency in our compensation to do the work, that again does not mean it's independent. But we've done work on the public deals alongside investment bankers. We had a really sizable deal where we actually represented OpCo and then HoldCo board of directors as the investment bankers were collapsing all of the structures together, very complicated post-restructuring capital structure together to get ready for a merger. And when the second round of that transaction, the actual merger happened, we actually represented the holding company because they had some differences in the boards, and it made sense that we did the holding and the investment bank did the actual operating company. So there are instances where we'll work hand in hand with the investment banker if there are conflicts, inherent conflict. And oftentimes it's the counsel that's going to be able to see that more than probably the management companies. And that's when someone like you, David, would advise them, I think you need a separate holding company fairness opinion. And that's when I see two opinions happening.
So are they not still doing in the larger public deals? I mean, there was a trend to get. I've been involved where there's been 3 fairness opinions in some deals that had a lot of conflict. Maybe key shareholders on both sides, and other sort of factors that led to that. But I had recalled that in big public company deals, you still have sort of the investment bank delivers one opinion, then you may have a second opinion, sort of an independent bank that doesn't have a contingent, fee component to their compensation. But I always worried about harmonizing those two, in the proxy statement and, the disclosures that go out to shareholders.
It's clearly a risk, when you have 2 different firms doing opinions. They're going to have, different comps. Maybe they get to the same answer, and maybe that's okay. But maybe the way they get there is different. I don't know whether, from a financial perspective, it's probably okay. From a legal perspective, I don't know. But I'll also make a distinction. You were talking about conflicts. The more there are internal conflicts, now, I'm not talking about financial advisor conflicts, just, not an independent board or whatever the case is, you're going to start seeing more and more of certainly second opinions that come up, because you've got these sensitive issues around different classes of stakeholders. We're not going to change decades of tradition of investment banks that have contingent fees issuing a fairness opinion, and probably if it's I'll call it run-of-the-mill kind of transaction, then it's probably okay. I think, until, a number of years ago, the only time that you saw a second opinion was when there was stapled financing attached to the deal somehow, where, in that case, where the investment bank representing the seller is also providing financing in part of the deal to the buyer. That was sort of that clear conflict. But other than that, as I said, for decades, the whole contingent fee thing really hasn't been an issue.
Well, we did get a couple good questions, and I think we've covered some of them. But if not, maybe pop another comment. But William, I think you had talked a bit about the synergies. I would mention that it depends on what you're talking about. If it's a cash out deal, then of course there's not going to be any synergies in the sense of what the selling shareholders are receiving, right? They're getting cashed out. And what value the buyer may bring later, they're not going to be a part of. Now, it gets more complicated, of course, if you're getting buyer stock. So in essence, you're rolling over into the buyer. And so, William, I think your comments, made a lot of sense. And if you're talking an appraisal proceeding, again, you don't really look at synergies, because the idea, at least in Delaware and most states, is it's what is the fair value of the equity that you hold, without considering any, impacts from the merger or special transaction.
Maybe that clarified, David. When I was talking about the synergies, I was really referring to solvency opinions, right? Is the go forward company pro forma solvent, right? So now you've got these synergies that you have to deal with in the analysis.
I see. Okay, that makes sense. Okay, so I think we covered that one. And then there's another great question on how do you get comfortable with the revenues itself? And I assume this might have, and please weigh in if I'm misreading it, a historical component, meaning you have to be, comfortable, I guess, with what their financial, accounts are reporting. And I assume in most cases you have audited financials or something. But then you have these projections, and we could do a whole another session on, projections, because I always find them just almost impossible to deal with. And I say that maybe a little bit overstating it, but, there's projections made for, internal purposes for the deal. Those might be a little aggressive. Then you get a separate set of projections. Sometimes you can have projections flying around in all different ways. And those are a very difficult situation, not only in terms of what's required to be disclosed to shareholders. You don't want to over disclose, because then it's confusing. And the courts have said that's no good, because you've now just muddled, you've thrown out everything. But generally you have to disclose, and you have to discuss and provide some context around projections that were used, in the fairness opinion process itself, not ones that were looked at and not used, but there's a lot of things around that. And I think this question goes to that. So how do you sort of get comfortable with the projections of revenues, of, earnings, the things that go into your DCF analysis or the other things? How do you get comfortable or stress test those, I guess I would say?
Yeah, I go back to diligence and also experience. And this is where I think having industry experience matters, because we've seen the same type of companies over and over again. Then you have pretty much just a range of what you think the growth rate will be for that company, or the margins and strategy they're working on, David. But what we need to see is where they've been the last few years, what kind of strategy they were trying to do, and how well they executed on those strategies, and then really deep diving into down to your customers. What are you projecting by key customers? Are there contracts in place? What are the support that really drive that 5% or 10% growth? And how much do we believe that story? At the end of the day, if for this is drastic, but if the company is declining 20% in the last 2 years, stabilizing, all of a sudden it shoots up 20%. That begs you have to think, well, what is that 20%? Is it 3% inflation? Are they having new huge customer wins that didn't happen in the last couple of years? So that's where you're really driving into that revenue. What's actually making up that revenue? Is it sustainable? How much of it's recurring? How much of it is a wish list versus actually 30% win rate, for example? So those are things that we spend a lot of time with management on, to really get comfortable and to see what type of results have they been able to gather or achieve in historic years when they're trying to do these type of growth execution plans.
The other thing too is when we're dealing with companies where commodity pricing is important, how is that factored into the projections? Where are they getting their data for forward pricing? I can recollect a situation a number of years ago for a chemical company that where commodity pricing was everything, and it was actually a merger with another chemical company, and the initial set of projections were developed using a wrong forward pricing curve, and so we had to sort of point that out and say, well, this isn't quite right. You need to use a different set of numbers to develop your projections. So there's also, I guess my point is, there's also independent sources of data we can use to corroborate the underlying assumptions and projections.
Oh, and we got a great question on using opinions in let's say divisional mergers, or where you're doing separations and you're dividing up assets and liabilities. Sometimes we've seen that in the market with asbestos liabilities being sort of carved out and sold off, spun off. In those, and in all of those, of course, you have, at least one solvency opinion. But it's very important in those kind of transactions that you do maybe what you don't do sometimes in a typical solvency opinion. A lot of times, I've seen, and we've talked about this offline, that you'll rely on management's estimates for contingent liabilities, whether it's tort type claims, asbestos, pension is another significant one that sometimes is there. When you're trying to spin off or separate out assets and liabilities, are there any special kinds of things that you think about when you're putting together, a solvency opinion or the financial opinions that accompany those kind of more specialized deals, where you're taking, risks or liabilities perhaps and isolating those and then moving them off? Because there, of course, you have a huge amount of potential fraudulent transfer risk, given the fact that you're basically leaving liabilities and cash and assets, but you have to get those numbers right. If it turns out that you haven't, left enough actual cash resources to satisfy the liability, then you run into, forward-looking claims coming back saying that, that may have been a fraudulent transfer. So how do you think about that, versus your typical M&A transaction?
Yeah, I mean, that's like another whole hour show right there, David.
I know.
Just
We need a part 2 and a part 3 if we're going to cover all of that. But
I mean, simplistically, the way we look at it is as part of our upfront diligence. So, do we take on this project? Who does the client have involved in terms of experts, third-party consultants, going back to, there are companies who are in businesses where environmental liabilities are sort of inevitable, whether they're just legacy things that they've acquired over time or they've just generated them. And when we hear that, we don't have an exact number for what those contingent liabilities are, and we're not getting, a third party to come, look at those, we haven't otherwise quantified them, we're just going to give you a number. That's where I have my antenna up. It doesn't happen too often, but I think there have been situations in the past where we've actually walked from opportunities because we just didn't think there was going to be enough diligence that the client was going to do around some of these, again, whether it's environmental liabilities or pension liabilities. Most of the time, it's really rare. I mean, most of the time, David, by the time the clients reach out to us, they've already hired all these different experts who will be providing data and background on all those things. So it's not an issue, but we will have to rely on them. We can ask questions around what's been done, but we're not necessarily experts in, asbestos liabilities, as an example.
Yeah, you have to build that up.
You
have to build that up, right? Meaning that you have to, those are the kinds of opinions where you're going to have maybe layers of experts, in different areas like asbestos or environmental or, pension liabilities. Chal, you had sent to me a New York opinion, or at least a summary of that. And, there was a glaring deficit in that opinion process where there were substantial unfunded pension liabilities, from what I could tell, estimated internally. And that happened to be, I think, in a private equity sponsored, dividend recap. So they were pulling out substantial amounts of money from the operating companies by way of a dividend. And they just skated past these, unfunded pension liabilities. It came back in that case, at least, I don't know whether it was resolved or not, but at least it sustained some preliminary motions to dismiss the case. So, that case is going forward. And there was a lot of criticism by the court for, just basically turning a blind eye, assuming away things that, were going to likely happen, and not making any real effort to try to get to the bottom of it. I think courts are generally pretty sympathetic if you're wrong, because they understand that there's so many different factors. And of course, looking in hindsight, a lot of things can turn out wrong. But what they don't like is when you ignore the process, ignore obvious red flags, don't take steps to try to ascertain, what the right approach might be. That's when you really get, nailed. In that one case that you mentioned, that seemed to be where that was from. So I think in these more complicated deals where you're doing, divisive mergers, or you're isolating liabilities, or doing other kinds of things like that, you really have to, put a lot more attention in, in really drilling down into where those contingent liabilities are, so that the opinion might be wrong still. It may turn out wrong in the end when you look back 8-10 years later, but at least you have a solid analytical framework to support that.
Yeah, and I'll add on to that, David, is oftentimes sometimes management would just rely on the audited financials, whether those contingent has been disclosed. And that's something that, is a very much an accounting standard versus actual. For when we're doing a solvency, especially a solvency opinion, it may not meet the threshold of being disclosed. It might not be in those audited, but that's up to the financial advisor and also counsel and management to really think through what are real liabilities out there. We've worked on cases together where we ended up having to advise the client jointly, you need to hire this person to do asbestos. Figure out what is your claim, figure out the process. Is the methodology correct? Are there updated methodology, updated estimates of those liabilities? And so I go back to, don't rely on the audit financial statements to
It's totally,
deal
yeah.
with events.
I'm so glad you brought that up. How did I forget that? That's like my main thing, but it is a good takeaway as we're kind of wrapping it up, that, for solvency opinion purposes, I don't think people really think about that. It is not, and the courts are very clear on this, both asset side and liability side, meaning that you can also consider, contingent assets or assets that are not yet sort of reduced to a balance sheet standard. Of course, be very conservative with that, because that could be abused. On the other side, as you say, Chow, it's not just liabilities on the balance sheet. There are, that's a very narrow view of probability and certainty of amount before you have to accrue, on a balance sheet. But when you're doing a solvency opinion or test, you have to at least think about and account for all liabilities, whether or not, there's something that you have to stick in a column on your, on your financial statement. So that's a really good point. Well, I think we're out of time, but William, Chow, any sort of final words of advice, wisdom from you both?
Not really. I mean, I think what I'll say, just based on our final little conversation that we had here, is, hopefully you have an engaged board. So when the board presentation is done, some of the things that we just talked about, the board members may say, well, you just accepted the GAAP numbers, but what about all these other environmental liabilities that we have that, probably should be considered? Why didn't you consider them, or why did management give you that direction? So that would be my only sort of parting comment.
Chow, anything?
Yeah, I would say if there is a semblance of conflict, whether it's private or public deal, whether you're doing, require fairness or solvency opinion, at the end of the day, the cost of the litigation and cost of it being the board director being unprotected versus being engaged, having done the process, the benefit is much more if there's a conflict there that you should just consider an opinion.
Yeah, definitely. Well, thank you, William, Chow. This was, as I said, I think hopefully people found it, enjoyable and learned a lot. And I think we definitely could do, I already can think of a part 2 and a part 3 just on some of these, things that we talked about. So thanks so much for, for doing this. And for anybody who, asked questions that we didn't answer, what you asked, just message me or William or Chow, and I'm sure we'll happily, talk with you about that. And then hopefully you'll join me. I think my next one, which I'm super excited about, on communicating with impact for anybody that has to present to a board or work with, C-suite executives who want to be more impactful in their communication. That's coming up with Nasheen Chen and Desiree Moore from my firm. Nasheen is a TEDx speaker and a great coach, and I think it's going to be a fantastic session. That's February 8th, so you can check that out. William and Chow, thank you again, and thanks everybody for joining us today.
Thanks for inviting us.
Thank you. See you soon. Bye.
Cheers.